All right, well, welcome everybody to our June 17th, 2025 edition of Bull Sessions. My name is Mark Robertson. I am joined here by the magnificent mathematician of Mid-Michigan, Ken Kavula. Good afternoon, Ken.
Hi, Mark. I thought we were going to do away with all those titles.
I,
Okay,
I keep I keep forgetting, and I rarely follow
keep
instructions.
forgetting.
So
Yeah, all
I
right.
think he did away with half of them.
I
Half of them.
yeah,
Great. Okay.
we used to introduce you like a boxer coming out of the corner, but
Yeah,
yeah.
yeah. Me and Clarissa Shields. Yeah. He wants to be called the Gwoat.
All right, just going to leave that laying out there. All right, we're
That
also
just
joined
stands
here
for
by.
greatest woman of all times. That's all.
Okay, okay.
She's a boxer. Yeah, Mark, we have a hand in the air. Right as we went on the air, Phyllis put her hand up. So, Phyllis, if you want to talk to us, whoop, Phyllis just took her hand down. Okay, so we'll assume that was inadvertent and keep going, Mark. Okay.
All right, we also have, speaking of great women, we have Kim Butcher with us. Good afternoon, Kim. She is actually in the middle of another construction project, so she'll be in and out. So she
Oh,
may
I'm
have like
here now. I just had to move the truck so that the neighbor can come get their John Deere tractor.
there you go. She's at it. And Houston's own Matt Spielman also. Good afternoon, Matt.
Good afternoon.
Matt, we are hot here today. I think we may be matching you.
Alaska is hot. Alaska just had their first ever in history heat warning, with temperatures possibly getting to 90.
Holy smokes. Good stuff.
Yeah, that and
Yep.
and that's in a state that rarely has air conditioning and generally looks for their houses to keep warmth in.
Yeah,
Absolutely.
that made the news up here as well, Matt. We're going to be heat indexes over 100 today. So,
Well, welcome to Texas. I'm conditioning you so you're ready to come down. We can have like an
but
August event or something.
But
All
then it's
right.
going to be 72 tomorrow, Matt. So,
All right. And speaking of hot, we have a special guest with us here this afternoon. Craig Bramer is actually vacationing in Key West. Good afternoon, Craig. Thanks for joining us today.
Good afternoon. And it's not as hot here as it is where you guys are at. It's only 82 to 84 every day,
Whoa,
but humid at 84 too.
that still sounds good. All right, so it's a busy cover slide. Those are our 12 sessions from the third quarter of 2020. And for the next few weeks, we are going to be going through a series from Punxsutawney to Pamplona. Ken, can we put both of those on our itineraries at some point in the future? Two good destinations that we need to check in on. But we are going to go back and revisit some of our sessions. And I will warn you in advance, there's some slides later on that are extremely busy, but they provide a bit of a roadmap. And I think you're going to like how we use them in the forum, but they can actually help you find sessions from the past. We'll talk a little bit about cash flow versus cash and the analysis of debt for companies, but and perspective. But there's some awfully interesting pictures of bulls on that slide, Ken. And I mean, I look back at that life after Google session fairly early as we got started. It was really, really pretty foundational for the type of stuff we've been doing for 5 years. What's your favorite?
well, I really kind of like Prove an awful lot. You know that. I've also just really enjoyed talking to all the new people and finding an audience, Mark, that has questions that are past the surface questions that we get a lot of times when we go out and visit clubs and everything. It's nice sometimes to get a little tiny bit deeper into things. I'm really interested in what you're doing right now with cash flow. You haven't convinced me all the way yet, but I'm really interested in it. So,
Yeah, you've always been a stubborn convincee, so
well,
that's a good thing.
that's the way we mold and mesh things so that they finally make complete sense to all of us. So,
You bet. And just remember, Ken, in the event that it's needed, the next time that you're afraid to share an idea or explore an idea like that cash flow thing, that somebody came into a conference room and said, "Let's make a movie about sharks and tornadoes and call it Sharknado." And that's down there by the Tasmanian Devil at the bottom of the screen. And we actually included that as one of our topics during COVID. There's a number of pictures of COVID on here. 2020 was definitely part of that scene. So let's go ahead and get into it because we have a ton of stuff to look at here today. Quick disclaimer, no investment recommendation is intended. This is entirely about education. It is about sharing and interpreting the ideas of the modern investment club movement. What do I mean? I mean the philosophies and methods and techniques of discovering an investment and subjecting it to an analysis in community. And we just simply know that finding opportunity and analyzing opportunity together makes a whole lot of sense. So you are responsible for making your own, for doing your own homework. We are not the boss of you. Make your own decisions about everything out there. If you'd like copies of these slides, and I suspect some of you out there may need them, if you're not a Manifest subscriber, we'd sure love to have you, but we would be happy to send you copies of the slides because you will need them. You will see that they form a bit of a roadmap. They're busy, but it's also an AI demonstration as we get into it. If you have any follow-up questions or future topics, our 2 email addresses are right there in front of you. Anything else, Ken?
No, you covered it well, Mark. Even though this is a short slide, we're still spending as much time on it. So keep on moving.
I didn't do the blah, blah, blah approach to it.
All right, you cut off three words. Okay.
All right, so, all right, and we are just reaffirming that the Compound and Friends actually switched to a Portillo's logo for their Chicago show last week. And that's Josh Brown and his gang. And on the right, we simply see that Portillo's is doing something on that Ishimoku cloud. And there is a lot more relish to the right. So I think that's a good thing.
Mark, is that Josh Brown's logo itself in the middle of the hot dog bun? That circle with the 3 bars?
That's Compound and Friends. Yep.
Yes. Okay. That's what I thought. Okay.
They modified it for their Chicago journey. All right. Just real quickly, we are going to be going over that Pamplona stuff, but this current weekly update includes a whole bunch of stuff with chips. It includes that most widely followed Apple. And again, that tribute in honor of the recently concluded cyber convention for better investing, or the NEIC. And again, it's from that book, that handbook, and it describes what we do. All right. A real quick jump in on perspectives, 10-year look backs for most of these, where it's different. There's a different date. But the point that we like to make is that some of our favorite companies are at the very top of this list. There are a couple that round out the rule of 5 at the bottom, but most of the indices are in the lower third, and that doesn't change. That Apple date is different because we're going to show you our analysis of Apple from August 2020. Note that it has basically matched the market at 14% since then. Anything else you'd like to add here, Ken?
No, my wife still owns quite a bit of Apple in her IRA, and she's very tight with it. So it's still sitting there. So
yeah, I have some also tucked away in some of individual portfolios, and I just try to avoid looking. That way I won't do anything. All right, here's our weekly look at the market. What do you see here, sir?
Well, not much is changing, but Value Line and MyPar have practically come together now and sat on top of each other. I was a little bit concerned 3 or 4 weeks ago when they had separated by 1.5 points, but they're kind of back together again. And the movement has not been in MyPar. MyPar has been amazingly steady in the 9.5 to 10 range, but the movements have been made by Value Line going forward. So
yeah, they've been
Value Line keeps cutting their 3 to 5 year future estimates, and they're down now to 9.7 when MyPar's at 9.6, and with Approve at 8.8, the numbers are doing very nicely with each other. They're playing real well in the same sandbox, and that's good.
So even with the last 6 or 8 weeks that have been extremely favorable, that last quarterly bar on the right has not caught up to the long-term trend line. So,
Well, I think what's been happening, Mark, is we get 2 or 3 days really great up, and then they take it back from us. So it's the old 2 steps forward, half a step back, that kind of a thing. I mean, we're getting hammered a little bit again today in the market after really moving quite nicely up yesterday. So. I'm more comfortable with markets that do that to me than I am with markets that have 12 and 15 days of all one direction. So, that bar doesn't bother me. If it doesn't hit the red line this quarter, then it'll hit the red line the next quarter. Isn't that the way to be thinking?
yeah, at some point in the future it will. All right,
Yeah.
pressing on. All right, just wanted to spend a moment talking about this. Is a bit of a pet peeve of mine, and just humor me for a couple of minutes here. I think simpler is better. I think a lot of things that I've witnessed in the world of investing are efforts to make things more complex uh, by people who want to give us help. I think the best helpers are those that simplify things. And I have witnessed evolution of things within the community. And what really kind of set me off is I received a number of emails asking me to rank a bunch of different ratios last week. And I think piling on more of what I think of as context elusive ratios is not a good thing. And so let me explain what I mean by that. When we look at companies at Manifest and we're trying to judge the debt capital part of the company, we basically look at 2 things. The first is how much long-term debt do they have? Now, we don't lose track of the liabilities, but how much long-term debt? What's the mortgage? So we basically take the long-term debt, divide it by their revenues, and that becomes equivalent to a long-term debt to income ratio. In the case of Apple, those are all Apple numbers. Apple's long-term debt to income ratio is 25%. Okay, so that's the first characteristic. And the second characteristic is, okay, depending on how much debt they have, what do they pay for an interest rate? And again, I think of it as a consumer, as a human. Forget that it's a company we're talking about here, and look at the questions down on the lower right. If you were offered a 2.3% mortgage right now, would that sound like a pretty good deal? And my answer to that is, yeah, I wish I could switch my mortgage. Got a relatively small mortgage, but I'd still like to switch it to a slightly lower number. So 2.3 tells you a lot. What does it say about the financial strength of Apple? I think it says a lot. Basically, they don't have to work very hard. Are banks willing to loan them money? Banks would trip over themselves to loan money to Apple. They might charge them 3%. Who knows what the number would be, but Apple would be a pretty good credit risk. So I tend to, and we also think about the cash in the wallet, obviously, but those 2 parameters are an important aspect of what we look at when it comes to the financial strength of a company. Now, that column down the center there is the debt to income ratios for a bunch of tickers. And obviously, there's a few companies that have no long-term debt. I'm looking at Stratasys and Powell Industries, that Betsy Wills company that we've talked about a fair amount. So again, it comes down to this whole notion on the right-hand side of I don't need any special notes or index cards or anything to remember this. I remember distinctly sitting down to buy a house and get pre-approved, and numbers were like 30%. When we moved to California, for some reason, the state of California, where all of you folks out there are simply crazy, the number there was 45% back in 1985.
That's okay.
So,
insult an entire state. Go on, Mark.
well, they are. They're lovable crazy. I will say that. Craig can probably relate. 45% out there at the time it was 30 in Illinois. So again, it's a number that you don't have to work to remember. So these are the 2 numbers that we pay the most attention to. Any comments, sir?
No comments at all. I've used some of these debt values an awful lot in my stock studies, along with the debt to capital that we look at consistently as well.
Mm-hmm.
So there's a number of different flavors of debt, and I think you have to be willing when when the debt strikes you as having a problem, I think you got to be willing to dig a little bit. We know how the accounting rules and regulations have altered a lot of debt ratios and makes it very difficult for us to parse them into language that we can understand and to numbers that make sense to us sometimes. So this is an easy one, and this one it's kind of hard to hide this particular number.
Absolutely. All right. Last week we had a question. I fumbled a little bit, and some of the people were very helpful in the audience and reeling me in. But this is just to make the point that the cash flow trend for Fastenal is there to remind us that the bottom is not the same. Cash flow is not the same as cash on hand, and I think you can see there's really not a heck of a lot of relationship between the two. So.
Yeah. Mark, can you back up, because we do have people that do calculations, and can you give them just a real brief idea of how you computed the effective interest rate?
Sure. The effective interest rate is simply going to be the annual interest, this 2,300 in the case of Apple, which is 2.3 billion, divided by this 98 billion. So 2 billion divided by 98 billion gets you to this effective interest rate. Same thing down here. Grabbing this number, what is the long-term interest divided by the total, and you can use long-term debt. Value Line's numbers are not very current. I don't know what they're doing, but that's simply how you do it. It's basically the interest paid over the long-term debt, and that's the same thing as the interest rate on a mortgage. Okay? All right, so pressing on, this is the DiVirgilio index. Nick and I had a debate about semiconductors back during the tariff squabble. I had actually bought some units of First Trust, NASDAQ semiconductor down the middle. I sold it about 10 days later. This was right after the tariff announcements. And the premise was no matter what happens with tariffs, it's probably not going to interfere with the supply chain for semiconductors. I was right. It's really a shame that I walked away. I walked away a week later with a 10% gain. And look at these numbers.
I can just see I was right, stomping your foot, Mark. Okay.
Well, yeah. I mean, I'm livid about being right about this one, and chickening out. So yeah. Again, when you get a powerful premise like that, maybe a little more conviction would have been in order here, Ken.
Well,
on my part.
You certainly. I don't know when to look at you for being highly having big convictions on a lot of things, because I've watched you have a lot of conviction about stocks that I'm wondering about. So
okay.
I just try not to make a value judgment on that kind of activity. All right.
Stick the knife in and keep turning. All right. All right. So here's a question that came. Actually, I got this from a couple of different people, and I don't even remember making the comment, at least not this vividly. But apparently I was talking about cash flow reversals. This is part of my convincing of you, Ken. Cash flow reversals in early stage companies, what does a bone crushing situation look like? And I think they're quoting me. Okay, what we're basically talking about here is a company, when it begins to generate positive cash flow, it generally captures the interest of not just traders, but investors. And you get a spike up in price. And the thing we're warning about is when the cash flow and or the earnings reverse and go negative. And in this case, Ken was astute in figuring out that there's no blue line here. There's no trend for earnings, but there is a lonely critter out here. That's 1 year of positive earnings. Okay.
Only took me 4 or 5 minutes to figure that out.
I know
Mark,
it.
so,
All the other earnings are down here somewhere off the chart. And the cash flow is generally going to be more positive than earnings, right? So they began generating positive cash flow back here, and then they had their hiccup, and they were forgiven for their hiccup. But then when things went south, and they actually began generating negative cash flow again. The stock price was absolutely punished. I call it bone crushing to go from 56 to $1.48. And that's what I
Well,
mean by that.
and 2 years of virtually no cash flow either way, of zero. 2 years of zero prior to that big drop didn't help either, Mark. So
No, but I think that qualifies as bone crushing. So yeah, we had the rocket on the left lifting off, and then I asked ChatGPT to give me a crashing and burning rocket, and it did. And then interestingly enough, when I asked Grok to do it, they told me they couldn't because they don't know what that actually looks like. So I think there may be some Elon Musk affiliation with that notion that they can't even visualize that crash and burn thing.
now, are you sure that rocket graphic on the right there isn't on its side right now?
Well, yeah, I turned it.
Oh, okay. I got it.
Wanted to bring it down. Okay, well, anyhow, good stuff. All right, so Craig, if you're still there with us, I love this chart, and he had sent it to us. I thought we'd invite him to explain what he likes and what he sees.
Thanks, Mark. Hopefully you can hear me. My system is saying I have a tough connection, so who knows?
I can hear you just fine, Craig.
Perfect. Okay, so when I saw this, it's the first time I've actually seen a chart quite like this before, and it's, in my mind, very simple chart. You have this blue dark line that's going up and going down, kind of like a heartbeat, and that's just simply looking at monthly returns over time. And my first reaction to it is, I think this is how most people who don't invest very much think about the stock market. They see the market go up, they see it go down, they see it go up, they see it go down, and it just goes up and goes down. And they don't really think about the longer term. In the light blue shade behind it is the longer term view over a 10-year time horizon. And it shows that the market, despite all that volatility over the 10 years, went up.
Oh, dropped out a little bit. Are you still with us?
Yeah, we lost the connection, Mark.
Oh,
Yeah.
that's too bad.
Why don't you finish his thought, Mark?
We'll give him a second. What he was getting to is, looking at the return or the level. Greg, are you with us now?
I'm sorry if I keep losing, but yeah, why don't you take over, because I think I have a tough connection here. I apologize.
Okay, not a problem. So again, he's talking about that blue shaded area in the background going from 10,000 10 years ago up to tripling in value, up over 30,000. And again, we as a community tend to think of that blue shaded area. And I certainly agree with the assessment that, anybody you talk about stocks at the hair salon or the barber shop, I think they see that up and down pattern. And basically think that it's a kind of a zero sum, game where it basically all comes out in the wash and you end up going nowhere. So I think this graph really captures that spirit.
I know when I presented graphs like this to classes of high school juniors and seniors, Mark, that there was always a little bit of confusion. Folks, there's actually two different y-axes on this thing right here, two different scales. And the shaded blue that Mark's been talking about is using the scale on the left, the dollar scale on the left, and the line graph, the one that's looking like Craig said, a heartbeat, that's using the scale on the right, and that's in percent terms of how much the S&P went up percentage-wise, and I think he said it was monthly. So we're getting two different scales. You really have two graphs that have been crunched into the single graph to show you what they're doing during the same time intervals. It's a little bit hard the first time you take a look at it, but I think that if you just don't panic when you're reading a chart like this, I think you can get some real good information off of it.
Yeah, and I think the average person looks at this and says, well, it spends as much time in the negative side of that line at zero as on the positive side. So how in the world would you ever triple in value? I think that's the message.
Correct.
It's a good one.
That is the message. I mean, as one of my club members said to me at one point, isn't the stock market just a casino?
Sure.
And I said, well, yes and no on a day-to-day basis or a month-to-month basis, but in the long run, no. It's a value generator.
Mark, this
Excellent.
goes hand in hand with that graph that we've been using in a lot of our presentations that shows the likelihood of having a gain in longer holding periods. This graph just complements that graph perfectly. And I think we decided that when the holding period got up somewhere near 20 years, the likelihood of making a profit moved very close to 100% at that point.
Absolutely. The other thing that kind of grabbed me about this, Craig, was you can see COVID on here. That's that 2020 dip in the monthly return. And what I find fascinating is the next month was a larger recovery than the original COVID dip. When you look at, how far this came back in the next month up here to this point.
Oh, yeah.
I mean, it was that quick. So anybody who ran for the hills, sold all their stocks, they had a very tough time returning to the party. So the message
I would agree.
The message here is invest regularly and don't worry about the line down the middle there.
I think there's another message also, Mark, and besides investing regularly, I think the other message this chart sends is to stay invested. You talked about running for the hills just a few seconds ago, but another way to say it is you have to stay invested. You have to be in on the bad days to reap the benefits of the good days.
Yeah, sort of like when you have a really good idea about semiconductor stocks and oh,
that really bothers you, doesn't it?
All right. Well, thanks, Craig. I think this is a gem. It's a keeper. We will probably adopt some form of this going forward. Check in on it from time to time. All right. On to our Groundhog Challenge results. Not a whole lot of changing. There's just some shifting and gentle shifting. I will point out that the magnificent mathematician has cracked the top 40.
Yay!
And the average groundhog is now up well into positive. And what is fascinating is 2/3 of you are beating the market. So I'm going to basically draw names out of a hat and let you guys pick my stocks next year.
We'll remind you that because they'll be me too.
I thought that's what you did this year, Mark. So.
Oh, I'd be a whole lot better off if I'd have done that. All right. So the medium and small companies are continuing to lag, and it's not improving greatly. That I know that by this 4.5 here on the value line index continues to lag the Wilshire 5000, and it's kind of frustrating. But hats off to Steve Weaver, who went from 8th to 2nd, and those two clubs are battling it up at the top. What do we have for a club count, Ken?
I think there's 11 in the top 40 right now. I'll count them again before I put it on my sheet, but I think there's 11. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Yeah, there's 11.
Our defending champions are here with Cowtown. And I'd be remiss if I didn't point out that Phil Crocker's club is ahead of last year's champions. He'll have fun with that tomorrow at breakfast. Good stuff. All right, keep it going because we got a bunch of stuff. Here is that Apple analysis that I mentioned just a few minutes ago from August 2020. And Apple had nearly doubled in price over the last 2.5 months going into that value line update. So the par had actually turned negative, something we don't see a whole lot of. And as we go forward and talk about this, I want you to think about this 16 and was that a reasonable number? I thought it seemed fairly reasonable at the time, and but that's kind of where this fell a little bit short. Okay, here's our current look at the company. And I want you to notice that the PE ratio is now up in the mid 20s on the current analysis. But Apple has continued to generate along. The growth has moderated a little bit. You see a gentle flattening of the sales trend. But notice where the PE took off and headed to after that report. So with 2020 hindsight in a rearview mirror, it actually topped 30 at the end of 2024, and that's where that PAR forecast didn't measure up. The company actually returned 14. Now it did only match the market at 14, but that is not something to be devastated by, for sure. So at 14% for the last 5 years, I wouldn't call that a failure, but it basically has only kept up with the market. Any other thoughts here, Ken?
No, just that when the market's doing really well, it makes it much more difficult for us to stay 5 points above the market. Much more difficult. And if you're seeing your plus the market numbers declining a little bit, you can point to the fact that the market over the last 3 or 4 years has been a phenomenal stock market to be invested in, even notwithstanding all the volatility.
Okay, a quick moment with the disruptors as made famous by CNBC. And again, this is a collection of private companies, so we don't want to get too obsessed with them other than to just throw the names out there. These are not something you can invest in directly unless you go one of the private equity routes like, I can't remember, the Crunchbase, which Hugh McManus uses from time to time. But again, these are just some names that you should have at the tip of your tongue if they do get involved in some type of public activity. Andrew Alla is working very closely with Meta and Databricks, which I run into all the time in the consulting end of the world, and they are working pretty closely with EXL Service Holdings, one of Ken's favorite companies. So again, just for the purpose of being aware of some of these names, Stripe, we're probably going to switch our payment processing to Stripe because I'm really ticked off at our current processor right now. So Stripe is a payment processing company, and here's the 11 through 30. Our daughter just got one of these rings to keep track of various things to try to improve her biorhythmic health or some version of that. But you can see, I've heard Metropolis talked about a lot with parking. Anything jump off this page that you can?
Yeah, the Einride, it's scary. Self-driving semi-trailers, that really scares me, yeah.
I don't know if it scares me more than what's already out there sometimes. Perplexity is right here. One of the AI companies that we follow pretty closely. And here is 31 through 50. Again, they're just here just so you recognize the names. None of these are publicly traded yet. Some of them are probably getting fairly close. And I've heard a few of these mentioned, but not terribly familiar with them. But keep them on the tip of your tongue and just be mindful that they're out there and they are evolving. Very early stage.
I got all excited when I heard about this list, Mark, and I thought, well, another great list of small companies I can put in. And then started to go through the darn thing and couldn't find a ticker for any of them. So that's really kind of disappointing to tell us all about these companies and then to make it clear that for the average investor, it's very difficult to get a handle on them.
Aren't they kind of doing what our friends at Forbes did with our best small company list? The unicorns or whatever they were calling them back many years ago.
Putting it out of the reach of the average investor, right?
It might be interesting to take 3 steps back and take a look at this list, see how many of them went public and how they've done since then, but not today.
Now, is this, Mark, I see that you've highlighted the 2022 list up there. Is that just, there's no reason that it's highlighted, is it, except that you can get it?
No, I'm just saying we might consider going back and seeing, well, how many of the 50 from that year are actually
But we're actually
investable.
looking at the 2025 list,
This
right?
is the current list, 2025.
Yeah.
Yep.
Okay.
All right. Good fun. All right, just a quick look at the Buttonwood portfolio. It has taken a bit of a hit with the activity in the Middle East, but not too bad. And we did do the transactions we talked about last week. We did get a 42-cent dividend, Ken, so we're living
All right.
high off the hog. And here's just a quick look, just a reminder of how sluggish it has been. I still say we're cursed because we've been hit with the drops in United Health Group. Who else took a pretty good hit? Lululemon. Novo, of course, has taken a hit. So
United Therapeutics took a hit too, Mark.
United Therapeutics right after we added it. Yeah.
Yep. Yep.
So again,
Although United Therapeutics has been coming back quite nicely, but it still took a hit over some terrible news about Medicare reimbursements.
yeah, and I thought a competitor had actually made some progress also
That was with the Halo company, Mark.
Oh, okay. I take it back then.
Yeah.
All right. So we are headed in the right direction again. I'm beginning to like this chart more and more. We're headed in the right direction there. Again, if you want to follow along with the actual dashboard, that is available at the bottom of the page. All right. We covered that in quite a bit of detail last week. So I'm frustrated, and I want to see I'd like to see green ink on that chart next time we pull it up.
Our friend Marie Frank, Mark, is reminding you that she ranted about the fact that many private companies are reluctant to go public. And she posted that on the forum.
Yes.
She indicates quite a while ago. Yeah, a couple of weeks ago.
I remember. Yep. And they're kind of stuck in the mud right now, wondering what to do next. All right. So here is a look at the presentations over the third quarter of 2020. Now, I did put them in any order. I actually put them in the order of appearance. What I've done here and what we're going to go through is I took all of the YouTube videos, just the links from the videos, and using Notebook LM, like we've talked about many times, this Notebook LM, I loaded in the 12 or 13 links to the YouTube presentations. It took me maybe 5 minutes to do that. It took 30 seconds to generate what you're going to see here over the next couple of slides. Now, these slides are very busy, but what they did is they went in and they organized the thoughts and tried to focus on some of the concepts. And what I'd like you to think of this as is possibly a roadmap, because on the Manifest Investing Forum, what I think I will do is go in, and when we see the mention of a bull session like this right here, we'll make it a hot link that will take you straight to the PDF and the direct link to the YouTube video. So that said, the busy slides, we're not going to try and read them, but if we see a highlight on these, go ahead and pick it up. Now I got to start with I'm bowing to the north of me. I mean, they caught on to this one pretty easily. And of course, that's a Mid-Michigan chant, which is now pretty much nationwide, thanks to Ken's participation in the national programs. So pretty good tribute. What do you like on here, sir?
I think one of my eye-opening things, Mark, was as we've presented to groups outside of the better investing community, especially into groups of AAII people that aren't necessarily fond of investing in individual stocks, our continual harping it has some baggage attached to it, but that's what we do. We talk all the time about investing in individual companies, not in markets, not in indexes, not in industries or sectors. And I think that we've made quite a number of converts in the AAII crowd, at least,
Absolutely.
in understanding that you can really be a very successful investor by focusing on ideas about companies and not getting any more complicated than that.
Yeah, and that's not just idle chatter. The local chapter for AAII has reached out. We are talking with them on some pretty powerful collaboration. So stay tuned on that if you happen to be in the Mid-Michigan or Southeast Michigan area. that could happen soon. What was I looking at here? I like this one. I don't know whether it was you or me that talked about it, but that seems like a pretty good theme. Speaking of collaboration, in a cloud, 5 years ago, good stuff. And of course, this description of what we do, the way that Notebook LM has caught it, that is what we do. Not trying to time the market. Timing versus timing. Timing versus time in the market. I think we were talking about before we got started here today. All right, so that's 1.1. Point 2, market dynamics and investor behaviors, how they classified some of this stuff. This one, I think all of us look back on very fondly, talking about these Roman candles or early stage investing, which comes up here somewhere also. But this bull session from July 2020 was where we began talking about life after Google. Pretty good stuff. Anything else on here grab your attention, Ken?
Well, I like that our audience keeps us honest at the roundtable, Mark, as well as the bull session. When we sell something that we later regret, they keep us honest enough to keep reminding us of the mistake we made. So,
all right, I'll highlight it because I probably said this one here. Yeah. Yeah,
but I know we have folks in our audience today that never pass up the chance to remind us about things that we've sold that we probably shouldn't have, and a couple of things that we held on to that we probably shouldn't have either.
Yeah, stubborn can work in both directions, that's for sure.
Yep.
And yeah, and it's probably also an excellent underscore. Now, Apple is slowing down a bit, but it is still a pretty powerful growth company. And Nicholson's advice to be slow to sell a company that has strong, we're usually talking double-digit growth. That applied back at that time frame, probably.
I think that last point, Mark, is foreshadowing all the work that we do in the fourth quarter of every year when we're talking about identifying small companies and then trying to come up with a list of what we consider the best small companies. But that September effect just makes it opportune for you to be looking at companies that might be beaten up a little bit. And that's where that whole thing comes from, I think.
Yeah, we'll do it again this year. I mean, we think that the January effect has been dislocated just by the characteristics and demeanor of the stock market compared to what it was 30, 40, 50 years ago. And we think that the shopping we do in September and October for the best small companies is prudent. And I'm sure we will have the same type of fun this year. All right, 3, investing tools and strategies. I think one of the more powerful things we've talked about over the years is the triple play, as Nicholson defined it, those 3 elements coming together. And I know that it has greatly helped me in bear markets and corrections over the years. And we actually built a screening tool. If you've not experienced it, go to Manifest, check out the stock screener. And one of the things you can do is display all current triple play potential candidates. So that was a good one. And that was back in that time. We were hot in July of 2020, Ken. I mean, that was a good one too.
Yeah, I think also, Mark, that back in 2020, we were talking about being able to hit a +5 to the market with sales growth around 12% or so. That had been the figure that was in a lot of the literature that we were reading at that particular time. But I think what we failed to remind ourselves was, and we've done that since, is how robust the dividends were in the 50s and 60s compared to how robust those dividends are today. And I think we've come around to the notion that in order to have that beat the market by 5 kind of a portfolio, you might have to push your weighted sales average up to 13 or even 13.5% to make that happen.
Yeah, there's all kinds of stuff here that I didn't recall that we were talking about projected return on enterprise value. We're missing an E here. That's Notebook LM's fault, but we were talking about it back then, and we were already talking about it as a validator or a reconciliation device for PE ratios. So
Well, we
going all the
hadn't
way back
gotten to
then.
the point where we were making presentations on it, Mark, but we were definitely talking about it a lot.
Absolutely. How about this one down here? This notion that Hugh McManus has often searched for opportunity near 52-week lows, and I remember that we did cover that pretty completely back then.
And we still come back to that consistently every 3 or 4 months, and remind folks that a stock at a 52-week low isn't necessarily something to avoid, and in fact, it might be a beautiful opportunity.
And I guess one last comment on this one. Make sure you understand these. We actually had a portfolio review session with an investment club where they had put trailing stop limit orders on the entire portfolio and sold a number of things they probably didn't want to sell. So make sure you understand what they are. A good tool for is, especially if you have an early stage company which has taken off, and if you you can actually use a trailing stop limit order in that case, although I'm beginning to question whether they ever make much sense after thinking through Netflix a little bit. All right.
I agree with you 100% there, Mark. If you're looking for a comment, I agree that I just don't find any real reason to want to use trailing stop losses. I think that they do unintended things, and deciding how far down to place that loss is just building in a loss to start with. As far as I'm concerned. So, when people tell me they put a trailing stop on something 40% below the current price, I'm saying to myself, well, you just guaranteed yourself a 40% loss, and leave it at that.
A decrease in value anyhow.
Yeah.
And yes, everybody, we were talking about cash flow 5 years ago. So that one's coming back full circle. All right, what I think will be interesting here is when the Notebook LM actually captured specific companies. So some of you have asked about in the past, how might I find, where we talked about, for example, Stryker. And when we get these all up in the forum, it will be searchable, and you'll be able to find that, yeah, that was during the 725 bull session. One of the instances when we talked about Stryker, and obviously some of those other more colorful things up at the top here. Early stage investing with Tesla. Here's that time when we talked about life after Google. So again, this could be an interesting roadmap. Ken's work on regional banks.
Yeah, that's a typo on the company because they heard us pronounce the company. It's pronounced Heico, but it's spelled Heico. And there was a time when they had two classes of shares that were persistently trading quite a bit apart, and there didn't appear to be that much difference between the two classes of shares, which means that if you were picking the right class, you had a real advantage if you were buying the stock. I've owned Heico for probably at least more than 15 years, maybe longer than that, and it's treated me quite well. It's a small defense contractor. And it's always had the general trend of upward, and the growth has been very, very healthy for a long time.
I've always wondered if it would be a acquisition by Buffett because it's a family-run business.
Yeah.
That makes a lot of sense. Yeah.
We've talked many times over the last 5 years about how you shouldn't be afraid of buying a smaller company that you think might be acquired. That's always not, well, I shouldn't say always, because I remember Clayton Homes, but it's most of the time a really lucrative position to be in when your small company is acquired by one of the big guys.
Yeah, Warren still owes me $1 a share on Clayton. That's
on Clayton, right?
Still there. And for like everybody trashes Jim Cramer, and he earns most of that. But back during COVID, this was really a fascinating exercise that we did. And he had unleashed this list of companies for that crisis. And this was an extremely well performing, uh, call it a demonstration portfolio or a tracking portfolio back in that time frame. And that was fun.
Yeah, some of the companies had a pretty big fade once COVID became a memory, but during that time, during that year and a half, 2 year period, this was a very, very consistently great list to look for ideas on.
Yep, good stuff. So again, and then this is the end of that first quarter. I kind of love, Ken, you already pointed this out. We were talking about this then.
Yeah, we had a different name for it. We weren't picking on an AI engine, but we were calling them computerizing mistakes, and that goes back to that quote we've been using from your friend in Chicago, whose name has escaped me.
Candace King.
Candace King, that's right, and where she warned that computers can only give you bigger mistakes. They don't erase mistakes. They only give you bigger ones, and they come faster. And if she thought bigger and faster was happening in the computer revolution, what possibly would she be thinking today about the AI revolution that's occurring right in front of our eyes?
Same thing. All right, so that's that one. And then here is the fourth quarter. And we won't take the same amount of time, but this was a lot of fun also. I mean, it continued over the next several months. And our friend Morgan Freeman is up there at the top. And we are definitely looking at a number of bulls as we searched for that ideal bull, which arrives down in the lower right-hand corner of the page eventually. Ken's battle with the monkeys was featured back in this time frame. The dart tossing monkey. And we spent a fair amount of time for about a month or so talking about our favorite investment texts, books. And the other one that I think was pretty powerful, certainly enjoyable, was the time we spent with the club questions, investment club style. So that was a pretty good time frame also. And here's just the summary from that same time frame. This is a little bit different. I used more of the PDFs from the presentations for this. I wanted to see how the two would compare. So this is PDFs. The other one for the third quarter was the actual links from YouTube. So it's actually using the YouTube programs. This, for the most part, used the PDFs from the sessions. And captured some pretty good stuff here. Anything jump off the page here, Ken?
Well, I really like to emphasize when I visit people out in the field, Mark, this concept of reasonable versus overly conservative. I find that many clubs, in their effort to be conservative, to be reasonable, go way overboard on the conservative side and end up doing as much harm to their investing portfolios as being overly aggressive can do. So we've had a number of discussions about you have to come up with reasonable judgments when you put together a model. No matter what the model happens to be, your judgments have to be something that can reasonably occur in order to get a result that can reasonably predict what's going to happen.
And yet, I go back to a morning in Brighton where a lady one of the attendees presented, I believe it was Walgreens, could have been CVS, but I'm pretty sure it was Walgreens, and she assumed a low growth rate and a low PE and low profitability, so the low end of all those all added up to a very, very pessimistic forecast for the company. And I don't want to say I admonished her, but I basically suggested that maybe that was being unreasonable. Well, folks, she was right. So you got to be careful out there. She was 100% right.
Well,
And
since we aren't mentioning any names or anything, I could make the comment, that blind squirrels find nuts sometimes. So I still would believe that at the time your admonishments made a lot of sense, Mark. I don't want you to beat yourself up for the fact that she ended up being right 3 or 4 or 5 years later. So.
all right, and here's that avoiding market timing again. Obviously, we must talk about this stuff a lot. But again, this is kind of the core. What will the company you're looking at look like 5 years from now? I never would have predicted that Walgreens would be in the condition that it is. Very few people would have.
Well, for that matter, CBS either.
Yeah. All right. Key tools and metrics. Again, this just reinforces the fact that we have looked at projected return on value for a long time. And just some other stuff there. You guys pushed us into the relative strength index. I think that's a good supplementary guide for exit and entry points. And
I'm still ruminating about Walgreens and CVS, Mark. The very first presentation I ever made nationally was a debate at a convention against some of the real heavy hitters in better investing. And the topic of the debate, which is the better investment, Walgreens or CVS, we could have shortened that debate down to the bottom probably and said neither one, and been correct 10 years later, 15 years later. So.
well,
I'm
the world,
still back there. Yeah.
in fairness, the world has changed. Kim, did you have a comment?
Oh, I was just going to say I like RSI real well, and I'm learning to like BPIs, and I that's one of my little metrics I always like to look at consistently, and it's been helpful to know that I need to have an extra eye on it real close because it's up over 70, 80, 90. Get up that, if the stock price gets up that high, it can stay high for a long time, but then it can have a nice correction so that then you know when it's time to buy more.
Absolutely. Yeah, some good stuff here. Yeah, I think we'll just press on. Here we go. A little bit of portfolio management, stock selection, certainly celebrating our efforts in the fall leading up to Halloween when we pick our small companies. And I'm sure we'll hear much more about that as we look at future years here. Kind of interesting here, Ken, that the selling decisions were itemized a little bit. We probably have some different opinions about some of those. I think those evolved after that date and time, which would have been December of 2020 for the most part.
I still think that these selling decisions are evolving, Mark. So
They are still evolving. Like we need for one, don't be stubborn, follow your own advice. We could add some other stuff. Good stuff. Okay, and here we've just got a review of concepts, contributors, if you want to think of it that way. Interestingly enough, that this bare naked million portfolio, which they led off with here, I believe it is now at $8 or $9 million. After 9 years, it had grown to 2.5 million, and I believe right now it's checking in right around $8 or $9 million. And again, this was that call during the Christmas holidays in 2006 where the gentleman asked me, what would you do with $1 million? So we had some fun with that. What else do you see here, Kurt, sir?
Well, it's just a compilation of things that we've admired and texts that we've read and thought had a singular impact on the way we invest. I haven't read every single one of them. You probably have, but I've read most of the ones on the list right here. And I tend to think that they've contributed to making me a very comfortable retiree.
Yeah, there's a lot of good stuff here. Kim brought us several of these, including this one, which actually led to a better understanding of the projected return on value as we developed it. And of course, the Motley Fool is there, and of course, Warren Buffett. I was really surprised. I didn't expect to be as pleasantly surprised by Snowball, the book about Warren Buffett, and it certainly is true. Find a good long hill and wet snow. And don't sell your semiconductor index fund.
You got to get over this now, Mark. Okay.
Mark,
Yes.
This is Craig.
Craig.
I was just going to say on that Buffett quote, I like the quote because it just ties in long time horizon, which he's always used, and it's a very simple thought process there. But I'll share one other simple thought process on semiconductors.
Yeah.
One reason I've held on is because everything I touch nowadays requires more and more semiconductors. So we're using more and more every day.
Absolutely. In fact, we've got a bunch of vehicles parked in lots waiting for their semiconductors to arrive, and I think all the car manufacturers have that issue based on what we're seeing in our area. So there's a tremendous hunger out there.
Well, I'll relate, Mark, one of the best semiconductor decisions that I made, and that was to not move away from my Oracle stock when the flashier semiconductors became prevalent in the marketplace. That didn't mean don't buy NVIDIA, don't buy AMD, don't buy some of those companies that are competing, but I didn't move away from the company that was selling more mundane semiconductors, and I've been greatly rewarded for holding on to that company.
Absolutely. And of course, this one we've talked about this one a number of times. And Matt, I think you or George or one of the members of the community showed us how you could get to the electronic version of that text. And it might be interesting to see if for people out there that don't want to read the entire book, what that would look like in Notebook LM. Because if you've got the full electronic text, could be an interesting experiment.
Yeah, I'm sure a number of people have summarized it, but it would be interesting to get the same treatment.
So we'll have to try that. See if we can make our own Cliff's Note on the Intelligent Investor and see how well they do. You hear the teacher in the background giggling. Yeah. Whenever I mention those, and then for some reason, doing it the different way ended up talking about resources. And it's a good time to remind that we do record all of these sessions. The recordings are what are used to generate that third quarter review. And this is how they summarized their perception, they being Notebook LM/Google. I think I'm okay with that statement. We're certainly trying and attempting to do that ambitious objective. Good stuff. So we'll continue down this path next week and see where it leads us. This is your reminder that these sessions are all maintained on YouTube under Manifest Investing. And again, if you find a topic or a company reference that you want to look up and you go back to the page, and you just simply look up the date, you can swing over to YouTube and find the programs. All of these are in chronological sequence. So you can page back through 5 years of bull sessions, and you can see the roundtables are interspersed in there also. All right, what have I been up to lately? On the right, that's the National Convention panel. I was hoping to be in first place after 10 days, but Pat Donnelly has assumed the lead. Although I think I'm a threat over the long term. As I told the audience, I'm thinking about the 2034 convention not the 2025 convention or 26 convention, 10 years out.
We've noted a number of times, Mark, that Pat has a barbell approach to these panels, and that he tends to have a stock near the top, and then he tends to have one somewhere on the other end of the list to balance it out.
Well, a couple of these are impacted by what's happening in the Middle East right now, for sure. Good presentations there. So if you're out there and you have access to those, Robin and Betsy did fantastic jobs. The guys did too, but anyhow, on the left, that's what I was doing last week, and I barely touched a cell phone or a computer for 4 days, and I feel fine. And
I think that's a wonderful way to spend 4 days with your 3 grandkids up in a treehouse with your wife. I think you had that's a great idea. I'm thinking about it for the one little grandchild I have left, and my wife and I. So it's thanks for spreading that word.
That's a treehouse located about 10 miles west of Toledo, and the view on the left is sitting on the deck, probably around 10 o'clock at night. Just a beautiful look. The walkways have, walkway lights, and the tree houses. There are a number of tree houses across the country, so it's not. Now you could actually go from just renting one of the platforms to put a tent on, but that entire structure that you see back at the top center of the center picture, that thing it's a condo. It's the only thing missing is running water inside. That happens to be 50 yards away. So we I don't know, Ken, but we were talking just last night at tennis about how our grandparents and perhaps great grandparents for some, they had this life every day. So I'm explaining to those 3 young men in the picture about this 50-yard walk to the outhouse at 3 a.m. Grandma and great grandpa did that at their house. That was daily life for them. And they're like, no way. And they're like, well, we knew they didn't have a remote for the TV. I said, no, wrong. They didn't have a TV. No TV, no running water. How did they live? And so it turned into an interesting learning experience. So I would highly endorse, exploring the Treehouse Village type concept. And I got to say, the Toledo Zoo vastly exceeded expectations for us. It's a great zoo. So if you're in the mid-Michigan or southeastern Michigan area and you didn't know that, I know many of you do. Just toss that out there as a possibility. So that's why I'm playing catch up, because I had a heck of a lot of fun with those 3 desperados on the picture. And my wife, Grammy. All right, anything else, Ken?
No, we're at 10 after 2, and it's time to say good afternoon to everybody, and hope we see you again on next Tuesday.
All right, thanks. Hope you enjoyed it. And again, think of those entries on the forum as roadmaps. And if you see a link that you want, let me know. Or if you have something that you'd like to add to this discussion, also let us know that. Thanks, Craig. Thanks, Matt. And thanks, Kim. And you too, Ken.
Thank you, Mark, Kim, Matt. As always, you're appreciated. And folks, without you as an audience, we wouldn't be doing this. So we hope to see you again next Tuesday. Good afternoon, everybody.
Take care.
Bye.